Imagine you're trying to grow a tree. You plant a seed, water it regularly, and just let it grow. You don't dig it up every few days to check on it. That's the basic idea behind the first and most powerful lesson from the Little Book of Common Sense Investing: buy and hold low-cost index funds. Instead of trying to pick winning stocks or time the market, which most people fail at anyway, you simply buy a piece of the entire market by investing in an index fund, like the S&P 500. So what is index funds? An index fund is like a big basket that holds tiny pieces of many different companies. Imagine going to a fruit market, and instead of picking just apples or bananas, you buy a fruit basket that has a little bit of everything: apples, bananas, oranges, grapes. That way, if one fruit isn't great that day, the others still make the basket worth it. An index fund works the same way, but with companies. It copies a list of top companies, like the S&P 500, which includes 500 of the biggest and most successful companies in America. So when you invest in an index fund, you're not betting on just one company to win. You're investing in all of them at once. If some companies don't do well, others usually do better and balance it out. This makes your money grow more steadily over time. Don't try to beat the market, just own the market. Most people think they can outsmart everyone else by picking the next winning stock or by jumping in and out at the right time. But the truth is, even professional fund managers who do this for a living often fail to consistently do better than the market. In fact, over long periods, most of them fall behind simple index funds. Bogle makes a bold claim backed by hard numbers. Most people who try to beat the market fail, and it's not just beginners. It's professional investors too. Bogle explains why this happens using simple math. Let's say the total market grows 7% in a year. All investors in total will average about 7% because that is the market. But here's the trick. Actively managed funds often charge 1% to 2% in fees. So even if a manager matches the market return, after fees you're only getting 5% or 6%. Over time, that difference snowballs. A 2% fee might sound small, but over 30 years, it could eat away over half of your gains. Bogle also uses data from the SPIVA S&P Indices versus Active report. Over a 15-year period, more than 90% of actively managed large-cap funds underperformed the S&P 500. That means 9 out of 10 pros, people with teams, research, and tools, couldn't beat a simple, unmanaged list of stocks. It's not just hard to beat the market, it's statistically unlikely. The more you try, the more you pay in fees, taxes, and mistakes. Costs matter a lot. This might sound boring at first, but Bogle shows that costs are actually one of the most powerful and underestimated forces in investing. Imagine two friends, Alex and Sam. Both invest $10,000 each and earn the same 7% return every year for 40 years. But Alex uses a low-cost fund that charges just 0.1% in fees, while Sam uses a typical actively managed fund charging 2%. You might think the difference is small, but by the end of 40 years, Alex ends up with around $150,000 more than Sam. Same return. Same starting amount. The only difference? Fees. Bogle calls this the tyranny of compounding costs. Just like compound interest helps your money grow, fees compound in the opposite direction, slowly draining your wealth. He explains that every dollar you pay in fees is a dollar that no longer earns returns, and over decades, that missing growth adds up massively. He also points to the mutual fund industry, where expense ratios, trading costs, and hidden fees quietly take a bite out of your returns. A fund might earn 8% on paper, but after a 2% fee, your actual gain is just 6%. That's 25% of your returns gone. Not once, but every single year. And it's not just about fund fees. High portfolio turnover, sales commissions, and even frequent trading in your own account can all erode your wealth. Bogle's solution? Cut costs wherever you can. Choose investments with low expense ratios, avoid unnecessary trades, and stay away from high-fee financial advisors. In Bogle's words, in investing, you get what you don't pay for. Compounding is your greatest financial ally, but only if you give it time. Bogle explains that wealth in investing doesn't come from sudden big wins. It comes from letting small gains grow over long periods. Think of compounding like a snowball rolling downhill. At first, it's small and slow, but as it rolls, it picks up more snow, gets bigger, and gains speed. That's what happens when you let your money grow over decades without interrupting it. For example, if you invest $5,000 a year starting at age 25 and stop at 35, just 10 years of investing, you could end up with more money by retirement than someone who starts at 35 and invests the same $5,000 every year until 65. Why? Because the first investor gave compounding more time to work. Bogle also uses the story of Benjamin Franklin, who left about $4,400 in his will for the cities of Boston and Philadelphia. He requested that the money be invested and untouched for 200 years. When the cities finally accessed the funds, they had grown to millions of dollars without anyone doing anything fancy. Just time, patience, and compounding. The key takeaway is this: the earlier you start and the longer you stay invested, the more powerful compounding becomes. Interrupting it by pulling money out too soon or constantly switching investments breaks the cycle, so don't rush it. Let your money sit, grow, and work quietly in the background. Speculation is not investing, and most people confuse the two. Bogle draws a clear line between true investing and dangerous guessing. Investing, he says, is about owning businesses and sharing in their long-term growth. You earn returns from profits, dividends, and steady appreciation over time. Speculation, on the other hand, is about trying to guess what prices will do in the short term, buying because you think a stock will go up next week, or selling because you're scared it'll go down tomorrow. It's gambling, not building wealth. To show how speculation can fool people, Bogle talks about the tech bubble of the early 2000s. Back then, investors poured money into internet stocks that had no profits. Some didn't even have real products, just because prices were skyrocketing. For a while, everyone felt like a genius. Then, the crash came. People lost fortunes not because the companies were unlucky, but because the bets were never based on real value in the first place. He also points to the dot-com craze and later to the 2008 financial crisis, both fueled by people chasing fast profits instead of focusing on long-term business fundamentals. In both cases, the story is the same. Speculation creates bubbles, and bubbles eventually burst. Bogle's message is clear. Don't invest based on hype, headlines, or hot tips. Real investing is patient and grounded. You're not betting on whether prices will go up tomorrow. You're buying a share of real companies that make real products and earn real profits over time. If you treat the market like a casino, expect casino results.